Hi, this is Amur with a weekend edition of the Bulletin Board Heroes. It is Sunday, the 12th of March. Got the FTSE doing what what we feared it might do, i.e. test the late January support area, breaking 78.80, which is the sell signal. Also broke that uptrend line there from October, near 7900. Current view obviously below the 50-day moving average, around 78.20. There's the risk not only of a further retest of the 7700 to 7720 zone, but also the old August and December resistance around 7600. Can't really rule out a test of the 200-day moving average as we had back in December. That's currently around 7430, but that is still a sort of worst case scenario at the moment. Any break back above 7820, we could be heading back towards 7950, although obviously at the moment that looks pretty unlikely. Moving on to the DAX, which obviously has joined in the fears regarding SVB. Perhaps not as bad as the UK market, that's quite typical, but still we have an island reversal. If that's a bull trap island reversal, a bull trap island top, landed right on that uptrend line from October. If the DAX was where the FTSE is now, it would probably be below 15,000. So that is a point to note if you think there's an opportunity there. Initial support there at the 50-day moving average around 15,100. Below that, we are risking 14,900 and the January support, mid-January support there for this market. But interestingly, we're not actually below RSI 50 there either. So the DAX certainly the best performer, the better performer there out of the big three that we're going to cover. And obviously the third of the big three is the Dow Jones. Here we're now not only below the 200-day moving average, we've also tested the November support area. That was around, or testing the November support area around 31,700. Below that, and the horror would continue down to 31,000 and resistance on the way down back in September. RSI not yet oversold, so that there's a message there that there could be still a further downside in this market. And the earliest opportunity on the upside would be an end-of-day close back above the 200-day moving average in that October support line there, around 32,300. So not looking good there at the moment. Sort of multiple top there since November, and that giveaway signal really back at the end of last week, I think it was, with the failure at the 50-day moving average and the failure at RSI 50. That was a very good leading indicator, or they were very good leading indicators on the downside. Clearly with Silicon Valley Bank on the back foot, doesn't help the look at Bitcoin. And here you can see that we've got this market right back onto the 200-day moving average, which is what we were fearing, 19,700. Reasonable bounce off that level and off the oversold RSI 30 zone, so that is helpful, but really, unless we can break back above the old February support there on 21,300, this market still looks like a sell into strength, especially after that unfilled gap to the upside through the 50-day moving average, which really foretold the breakdown that we've had. End of day close back below the 200-day line, then we risk further fall down towards 18,400, which was the old December neckline resistance. On to the stocks, an interesting one here from Amur, where people poo-pooed the whole deal that they had, but obviously that's changed in terms of the events of the last week. Beautiful mid-move consolidation there, so long candle there up day during the week or at the beginning of the week, and all we need to see now is an end-of-day close above 1.7 pence, and that could take us to 2.2 pence and that early 2022 resistance line projection. So very strong move there with both the 50 and 200-day moving averages both rising. The fact there's been such little retracement, we've only retraced about, a quarter of that big up day. That does show big strength in a stock which obviously traditionally has just been a sell into any strength over the recent past. So above 1.4, looking for 2.2 there on Amur. Onto a stock which has captured the imagination of retail investors of late, BSF Enterprises, I think with the artificial pork chop, I think that they produced. Here we've got a break of that resistance line there from February, break of the 50-day moving average around the 17 pence level, and above that, looking for the top of that rising trend channel from July last year as high as 30 pence, maybe sometime in May, maybe early part of May, but 1 to 2 month time frame, could be sooner. And the upside certainly valid while we hold above the 50-day line and 17 pence. Ideally, we don't want to see any price action sustained below the 15 pence level. after that little bear trap we had midweek below 15 pence this week. On to one of the surprise movers for the last week, Celadon. Here, what was interesting is that I did actually spot the moves on Wednesday and Thursday, just waiting for an end-of-day close through the 60 pence area, which was neckline resistance, but obviously we got that and much more on Friday. The view now is that, although obviously shares have already moved a long way, the key point here is probably the old May support there around 86 pence. Above that, we're looking for the shares to retrace, potentially up to the early 2022 resistance area, £1.50, £1.60, but obviously more for people who are already in the stock and are holding on rather than anybody trying to enter the fray, which could be a little bit painful if it goes wrong. On to a stock which has been very pleasant over the recent past, Cizzle. Here the shares were called up from basically 2 pence on a technical basis, and they obviously delivered up to nearly 5 pence at best earlier in the month. Current position is that we've had a bounce off resistance on the way up around the 3 pence area. There is a risk of a move down towards the floor of the channel there, currently around 2.5, 2.7 pence. But while there's no end of day close back below 3 pence, then we're looking for as high as 5.5 pence by the end of next month. If you are a bargain hunter, you'd be looking for 2.5 pence on an intraday basis, perhaps. But shares looking very good on this chart, given the golden cross that worked on this situation late last month. Moving along to a stock which has not been in such fine form. Lots of positive noises coming through. Here we've had another test, or we're having another test of the low 7 pence area. Still looking for the shares to remain in a range between 7 and, let's say, 9.5 over the near term. We've got the 200-day moving average there at 9 pence. But at the moment, we're waiting for an end-of-day close at least above 7.6 pence recent resistance before assuming that there'll be a move back towards the top of the range. So that's probably the best way of playing it, waiting for 7.6 to 7.7 pence to be broken and then calling the stock higher. On to Golden Prospect, which I haven't looked at for ages. Here we've had a rebound with bullish divergence, little bear trap rebound there, below 30.5 pence, and the view is that above 30 pence we could see the shares head back up to the top of the range, top of that channel there from the summer, as high as 38 pence over the next 1 to 2 months, maybe sooner. A bit of a better look to mobile streams of late. The end of the week saw the shares just closing on the 50-day moving average. Obviously, we were actually above it. We've been above that before, but Wednesday's hammer candle and then the close above the 50-day moving average gives this stock a bit of a better look, and potentially a move up to 0.18 pence by the end of next month, while we hold above the 0.1 area. Microsaic also had a better week. Here we had a nice move on Friday, a rising trend channel there from back in September. We're looking for an end-of-day close above 0.04.5 to take us up to as high as 0.08 by the end of next month, with no new lows below 0.03.5. Good close for OKYO Pharma on Friday, which was significant in the sense that it was just above the 200-day moving average. So the 50-day moving average, that's now rising near the 3 pence level, and above the 3 pence level, looking really for the return to resistance on the way down at 5 pence by the end of next month. But this could be a decent turning point after that trendline break that we had from September early this year. Predator also delivering a bear trap rebound. Was a tough ride, I suppose, down from 12 pence to under 3 pence November to January, but current situation is that we found good support above the 50-day moving average at 7.5 pence, and above that looking for 10 or 11 pence by the end of next month, maybe up to 12 even at the top of that broadening triangle. Closed just shy of the 200-day moving average on Friday. But the key here is holding 7.5 pence. Premier African had a good run as well. The good run, especially these days, comes in the form of being up on a horribly bad day. A gap fill rebound there down to 0.65 and above 0.65 on an end-of-day close basis, looking for 0.85 by the end of next month. We've got a resistance line there from I suppose back in the second part of last month, so it looks like we've broken that, and that is a healthy sign. as is the way the 50-day moving average is currently rising sharply. Just a few stocks to go now. First is Rockhopper, which gave people a rather uncomfortable ride at the, I suppose, late summer last year. Here we had vertical move, and that was obviously sold into, and when there was a gap down as well, just to add insult to injury. This month has been a good start, though. We've seen a good start, so breaking 10 pence, which was neckline resistance. Above that, we're looking for 18 pence at the top of that rising trend channel from the summer of 2021. Extended RSI uptrend line there as well, which is healthy, and also the 50 and 200-day moving averages both rising, so the next time they cross, you'll have a pretty decent golden cross buy signal. The run-up to such crosses tends to be the strongest part of the cycle. If you're looking for a near-term trigger, then the top of that gap there at 12.25 pence on an end-of-day close basis, i.e. we close above that, would be the next trigger for a move towards 18 pence. Just a couple of stocks to go now. First one is Tertiary Minerals, where I wrote up the shares, I think around 0.13, probably 1.14, and we had a good weekly close there, just above the 200-day moving average. Above that, we're looking for 0.3 pence, as the article suggested, and we're helped by the way the 50-day moving average is rising, even though the shares are near the lows, and we had bullish divergence with the bear trap rebound from below December support at 0.12. So lots of plus points there on the technicals. Finishing off with Tintra, which has managed to break a line of resistance there from December. That was done really on Friday, £1.20, and what a move, really. What's interesting now, or what will be interesting, is to see whether the shares can close above the 200-day line at £1.70. If we can do that over the next week, we should be rushing back towards the 225 area, which was 2023 resistance, or at least the initial 2023 resistance. In fact, we actually spiked on an intraday basis through 250, but the close is there around 225 at best. At this stage, only well below 130, delaying the upside scenario. That's it for me today. More updates during the week.